the Chinese in particular have been stripping gold out of Western vaults, out of Western mines, whatever. They have been accumulating gold. I have a copy of, in English, of the original articles appointing the People's Bank of China to act for the Chinese nation in the accumulation of gold and silver, and that was dated in 1983. Now, since then, there's been massive investment inflows, and in through the 80s and in the 90s, massive and growing, and through into the 2000s as well and beyond, growing export surpluses. If you're old enough to remember how central banks, how conservative individuals, non-speculating individuals, those who wanted to protect their wealth for the long term, how they looked at gold, and this would include the Chinese, they reckoned that you should have somewhere between 10 and 15% of your money in gold, and the rest is credit for you to, do whatever, buy houses, buy expensive yachts or whatever. That's the Arab approach. If you just take that 10% and you look at the cross-border flows, firstly the big capital inflows in the 80s, the amount of stuff crossing the PBOC's desk, you take 10% of that at contemporary prices. And remember, this was a bear market that took the gold price down to $250 in 2002. Then I reckon that was over 20,000 tons. That's a substantial amount of gold. The largest, in fact, of anywhere in the world. If you look at the savings ratio, the savings ratio in China is over 40%. But more importantly, the household savings. In other words, this is just households. These are individuals who are saving, if you like, their own earnings, their own profits, whatever, is estimated to be 35% of China's GDP. That is roughly $6 trillion. So you've got $6 trillion of savings going into property, stocks. It can't go into foreign currencies because there are exchange controls. That's not permitted, and it goes into bank accounts. Property is no longer fashionable. We needn't discuss that. The stock market for the last 3 years has gone down very substantially. It's recovered a little bit this year, but I would suggest that the sort of rather conservative saver in China is not really all that switched on by the stock market. So what do? Well, it's all been accumulating in the banks, and the banks offer what they call certificates of deposit, which is slightly different from our CDs. A certificate of deposit in China is basically a deposit of up to 3 years with a fixed rate and a better rate of interest than, let's say, instant withdrawal or 1 month money or whatever. But these banks also offer gold accounts. And this is something which was brought in by law, getting the banks to do this. And it's all part of the gold ownership story, which China is working towards as a means of its ultimate protection from, our attacks on China, or our attacks on ourselves as we destroy our own currencies. All you need to have is 500 yuan, maybe 600 yuan in some banks. That's the equivalent of about $70 to $80 in order to open a gold account. Now, I don't know whether the banks, match the gold account with physical gold. Suspect that they probably run a sort of fractional reserve system. I doubt if it's highly leveraged. I very much doubt that, because they know the official policy. And I would think they're in the market picking up gold whenever they can. When it's offered, take it. I think that's what they've been doing. And just bear in mind that, the alternatives for this $6 trillion equivalent. $6 trillion, incidentally, at the current price is 75,000 tons of gold. I mean, we're talking a considerable amount of moolah here. You can see how it is that the shortage of gold in Western markets has been getting greater and greater and greater. You only got to look at COMEX and see the withdrawals. Now, the withdrawals don't necessarily go out of the vaults, but they certainly go out of the possession of the liquid hands, if you like, in the COMEX market. And I mean, there's staggering amounts being withdrawn, and now this is also happening with silver. So where does gold go in this? Well, let's put the monetary thing aside and just think in terms of supply and demand. Well, there's no supply, and there's demand, which on rising prices could indeed become self-feeding, because another aspect which various of my friends have noted is that in the futures market, the Chinese speculate wildly. I mean, they want leverage. They really do. But we're talking about Chinese traders, not the housewife. They know that, they're close to the financial system. They know the story I've just been telling you about the People's Bank, etc., 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 about the official attitude to gold, the official attitude to the dollar, and so on and so forth.
When examining the savings ratio in China, we find a figure over 40%. More importantly, household savings, meaning individual savings from their earnings and profits, constitute about 35% of China's GDP, translating to roughly $6 trillion. This substantial amount of savings faces limited investment options. Chinese citizens cannot easily invest in foreign currencies due to exchange controls, which funnel savings into bank accounts and property. However, property investments are losing favor, and the stock market, which has seen significant downturns over the past 3 years, doesn't attract the conservative Chinese savers. As a result, savings have accumulated in the banks, which offer certificates of deposit CDs, with fixed rates for up to 3 years. These CDs offer better interest rates than instant withdrawal accounts or shorter-term deposits. In addition to these CDs, Chinese banks also offer gold accounts. This initiative, mandated by law, is part of China's broader strategy to promote gold ownership among its citizens as a protection against currency devaluation and economic instability. Opening a gold account in China is accessible, requiring only 500-600 yuan, equivalent to about $70-80. While it is uncertain whether these accounts are matched with physical gold, it is likely that banks operate on a fractional reserve basis, albeit with a conservative approach aligned with official policy. These banks probably purchase gold whenever possible to back these accounts. Considering the vast amount of household savings, amounting to $6 trillion, this represents approximately 75,000 tons of gold at current prices. This immense demand underscores why there is a growing shortage of gold in Western markets. The withdrawals from the COMEX, Commodity Exchange Inc., are significant, though not necessarily leaving the vaults. They are certainly moving out of liquid hands in the COMEX market. Now let's consider the broader implications of supply and demand for gold. There's a critical shortage of supply, and demand is only increasing. Rising prices could lead to a self-perpetuating cycle of higher demand. The Chinese, in particular, are known for their speculative behavior in the futures market, seeking leverage and opportunity. These traders are acutely aware of the financial system's dynamics and the official stance towards gold and the US dollar. The People's Bank of China, PBOC, has been quietly reducing its dollar holdings and increasing its gold reserves. This strategic move can be attributed to concerns about the future value of the dollar and aligning with the Communist Party's objective to minimize dependence on the dollar. Other central banks in Asia are following suit, driven by similar geopolitical and economic considerations. These banks are preparing for a potential shift towards a gold standard, necessitating substantial gold reserves. India presents an interesting case. Historically, India has been Keynesian in its economic approach, viewing gold as a non-essential asset. However, this stance is changing. As a member of the Shanghai Cooperation Organization, SCO, India is now privy to strategic discussions and is accumulating gold in anticipation of a shift towards a gold-backed economic system. This change in policy reflects a broader recognition of gold's importance in maintaining economic stability and sovereignty. At the market level, Chinese entities have been systematically acquiring gold from Western vaults and mines for over a decade. This sustained effort underscores China's commitment to strengthening its gold reserves. The original articles designating the PBOC to accumulate gold and silver date back to 1983, reflecting a long-term strategic vision. During the 80s and 90s, China saw massive investment inflows and growing export surpluses. All foreign exchange transactions were managed by the PBOC, giving them a strategic advantage. Historically, conservative investors, including those in China, have maintained 10–15% of their wealth in gold. Considering the massive capital inflows during these decades, the amount of gold crossing the PBOC's desk was substantial. Even during a bear market, when gold prices dropped to $250 in 2002, China's gold reserves grew significantly, likely exceeding 20,000 tons, making it the largest holder of gold in the world.
The People's Bank of China has been buying gold, but actually it hasn't been buying gold, it's been selling dollars. It's been reducing its dollar commitment. Now, as to whether it's frightened about the future value of the dollar, or whether it is merely in line with the Communist Party's meme of reducing the involvement of the dollar, you can pick either of those reasons. When we look at the other central banks, predominantly in Asia, who have been accumulating gold, again, I think there are these twin reasons. They can see that the geopolitics is actually working against the dollar, so the dollar's value is likely to decline on that basis alone over time. Furthermore, they can see, they will know, they have the inside track. They have these sort of quiet meetings to which we are not privy. Amongst the monetary panjandrums, if you like, in the Asian central banks, knowing that they're moving towards a gold standard. It's probably some way off, but obviously you need to accumulate some gold. Now, India is very interesting in this because India has denied gold. India has been Keynesian in its approach to economic management. And I think that also includes, sort of a sort of semi-official view that gold is a pet rock. But that has now changed. The government is now accumulating gold. Why? Because they're a member of the Shanghai Cooperation Organization. They're privy to the conversations, and they know that that's the direction in which it's going. They don't want to be first going there, but they know that they would be complete idiots not to accumulate some gold, even if they hope the problem will go away. So that, I think, is what's happening at the central bank level. Now, at the market level, we have seen for well over a decade now that the Chinese in particular have been stripping gold out of Western vaults, out of Western mines, whatever. They have been accumulating gold. I have a copy of, in English, of the original articles appointing the People's Bank of China to act for the Chinese nation in the accumulation of gold and silver. And that was dated in 1983. Now, since then, there's been massive investment inflows and through the 80s. And in the 90s, massive and growing, and through into the 2000s as well and beyond, growing export surpluses. Now, all the foreign exchange transactions are handled by the same organization, the People's Bank of China. So all those flows go across their desk. Now, if you're old enough to remember how central banks, how conservative individuals, non-speculating individuals, those who wanted to protect their wealth for the long term, how they looked at gold, and this would include the Chinese, they reckoned that you should have somewhere between 10 and 15% of your money in gold, and the rest is credit for you to, do whatever, buy houses, buy expensive yachts or whatever. That's the Arab approach. If you just take that 10% and you look at the cross-border flows, firstly the big capital inflows in the 80s, the amount of stuff crossing the PBOC's desk, you take 10% of that at contemporary prices. And remember, this was a bear market that took the gold price down to $250 in 2002. Then I reckon that was over 20,000 tons. That's a substantial amount of gold, the largest, in fact, of anywhere in the world.
As we continue to delve into the strategic importance of gold, it becomes evident that China's accumulation strategy is not just about hedging against economic instability, but positioning itself as a dominant player in the global financial system. This vast accumulation of gold underscores a shift in the geopolitical landscape, where gold is becoming a pivotal asset for economic security and influence. The strategic shift towards gold is also evident in the actions of other central banks, particularly in Asia. Countries like Russia and Kazakhstan have been significantly increasing their gold reserves, driven by similar motivations as China. This collective movement towards gold highlights a growing distrust in the US dollar and a recognition of the inherent value and stability that gold provides. For individual investors, this global trend offers a clear lesson. Gold remains a critical asset for wealth preservation. As nations accumulate gold to safeguard their economies, individuals can similarly protect their wealth by investing in physical gold. This strategy is not merely about reacting to current market conditions, but anticipating long-term shifts in the global financial landscape. Gold's role as a store of value is becoming increasingly important as traditional financial systems face unprecedented challenges. The persistent accumulation of debt by governments worldwide, particularly in the US, poses a significant risk to the stability of fiat currencies. The US national debt, now nearing $200 trillion, is unsustainable. The government's fiscal policies, characterized by continuous deficit spending, exacerbate this issue. Inflation is not a transient phenomenon. It is a structural problem that will persist as long as these fiscal policies remain unchanged. The implications of this debt are far-reaching. As the value of the US dollar declines, the purchasing power of savings held in dollars erodes. This scenario makes gold an attractive alternative. Unlike fiat currencies, gold retains its value over time, providing a hedge against inflation and currency devaluation. The strategic accumulation of gold by central banks also indicates a potential shift towards a gold-backed currency system. The discussions within the Shanghai Cooperation Organization (SCO) and the actions of the BRICS nations suggest that a move towards a more stable and reliable financial system may be on the horizon. This shift would elevate gold's importance even further, making it a cornerstone of global trade and finance. For viewers and investors, the key takeaway is clear. The strategic value of gold cannot be overstated. In a world where economic policies and geopolitical dynamics are increasingly uncertain, gold offers stability and security. Investing in gold is not just about protecting against immediate risks, but positioning oneself for long-term financial security. Furthermore, silver should not be overlooked. Often referred to as poor man's gold, silver has significant industrial applications, making it a valuable asset in its own right. As the demand for industrial metals grows, so too will the value of silver. Like gold, silver offers a hedge against economic instability and currency devaluation. For those new to investing in precious metals, it's essential to approach this market with a strategic mindset. Diversification is key. While gold should form the foundation of your investment portfolio, including silver and other precious metals can enhance your protection against market volatility. Additionally, consider the various forms of gold and silver investments, including bullion, coins, and mining stocks, to diversify your holdings further. Understanding the broader economic and geopolitical context is crucial for making informed investment decisions. The actions of central banks, the state of national economies, and global trade dynamics all influence the value of gold and silver. Staying informed about these factors will help you make strategic decisions that align with your financial goals. In conclusion, the value of gold and silver goes beyond their physical properties. They are strategic assets that offer stability and security in an uncertain world. As geopolitical events and fiscal policies continue to shape the global economy, these metals will remain critical for preserving wealth and achieving financial stability. Investing in gold and silver is not just a defensive strategy, it's a proactive approach to securing your financial future in a rapidly changing world.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.